Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, I'm Vinay Joseph and welcome to another edition of our weekly podcast, The Week That Was. Indian stocks continued to trend lower this week, with the Nifty index falling by close to 2% amid a global risk-off sentiment, hawkish US Fed commentary, and large-scale FIIs selling, with about $2 billion worth of equities sold by foreign investors in the week gone by. Broader markets corrected in line with the large-cap indices. Among sectors, auto and energy were the only sectors to end in the green, while IT, banks, realty, and metals saw cuts of over 3% for the week. We had also some macro data. Wholesale price inflation for the month of March came close to 15%, which follows the higher than expected CPI print of 6.7% the week before. This, coupled with US Fed Chair's comments of a possible 50 bips rate hike in May, drove a sell-off in US Treasuries. This pressurized domestic bond yields. However, the benchmark 10-year Indian government bond yield for the week fell by 5 bips to close to 7.2%, recovering a bit from oversold conditions. With crude oil prices still trading above $100 a barrel, the INR continued to be under pressure against the USD, depreciating 0.4% for this week to continue to trade above the 76 handle compared to the USD. Moving on, one common question among investors which we are getting is that despite the rising macro headwinds, from surging crude oil prices to rising interest rates and bond yields amid sharp foreign investor outflows, why has the Indian market held up better than expectations? In our view, two key factors are in play. First, corporate earnings cycle remains very strong, with the Nifty earnings for the current fiscal year ending 2022 likely to register a 35% growth. This would be the highest EPS growth for Nifty index since the fiscal year 2004, and this is already coming back from a strong 15% EPS growth which we saw in the previous fiscal year of 2021. The second factor is that domestic investors have shown great resilience with consistent inflows into equity markets during this challenging period. Since October 2021, domestic investor inflows have totaled close to $20 billion, which more than offsets the entire FII outflows we have seen during this period. From the earnings season which is ongoing, investors would look at the commentary from corporates, and that will be analyzed very closely to see how sustainable this earnings cycle is going ahead, given that earnings matter the most for equity returns in the longer term. While input cost pressures are likely to lead to margin compression and profitability hit for consumer-related sectors and cement, other big sectors like financials and IT would be largely unaffected. The impact of rising commodity prices on earnings is far more for the broader market and the economy than the Nifty companies, given the representation of those sectors in the index is small. Further, strong demand visibility in the IT sector, a pickup in credit growth, and normalization of asset quality should lend support to Nifty earnings in the coming fiscal year 2023. Additionally, deep cyclical sectors like energy and metals are likely to benefit from higher commodity prices, leading to overall strong earnings aggregate growth. Putting it all together, consensus expects that Nifty earnings growth for the fiscal year 2023 will continue to remain resilient and strong, with close to 20% EPS growth expected. We'll pause here, and that's all for this week. Thank you for listening to our podcast, and if you find this useful, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.